Good afternoon and welcome back, everyone, to our Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at OptionsPlay, and I am honored to have two legends with me this afternoon, Tom Sosnoff from tastytrade and tastylive, and Brian Overby, our Senior Options Strategist here at OptionsPlay. Gentlemen, both welcome.
Thanks for having us, Tony.
Awesome to be here, Tony. I'm excited to get going with this session. It's been a long time since I've chatted with Tom.
Yeah, this is going to be a fun session, to be perfectly honest. We'll get through a lot about both of you, a little bit of your history. We'll talk markets and also talk option strategies. We'll kind of cover the full basis. Just a reminder for those of you that are joining us for the first time, every single Thursday afternoon, we are dedicated here at OptionsPlay to helping you improve your options trading by empowering you to trade sustainably and confidently by doing these options education sessions and cover a wide variety of topics, not just options trading, but technical analysis, fundamental analysis, trading psychology, and have guests like Tom Sosnoff and Brian Overby to kind of discuss option strategies and bring a different perspective. During today's session, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we might use as example purposes during today's session. So we'll be covering quite a bit, but what I'll do is I'll start off by giving both Tom and Brian a bit of time to introduce themselves for those of you who may not know who they are. And then we'll talk a little bit about the current market environment, which is a bit of a strange environment, and kind of ask both Brian and Tom how they would think about trading this type of market environment. And then what we're going to do is we're going to pick their brains. We're going to ask them what their number one option strategy is. What do they trade most often, and kind of get a better sense for best practices for order entry, order exit. I'm going to take notes as we go along, as they kind of share with you those their favorite strategy, and we will make sure we incorporate those notes and send them out with the recording. And at the very end, we'll let Tom walk us through the tastytrade platform as he walks through some of the trades that he likes to trade, and then we'll open this up for Q&A here at the very end. And I'll show you also how to set up a tastytrade account for those of you who that do not have one just yet. So let's start off. Tom, we've been doing this quite a few times, but for those of you that are joining us perhaps for the first time, first of all, I see hundreds of you in the chat room already chiming in. So please, if you're joining us for the first time, feel free to type hello into the chat window and tell us who you are, where you're from. As you can see, we have a very vibrant community of traders that are here to support each other and learn from each other. But for those of you that don't know, I have been doing this for roughly 19 years, and I started trading options watching Tom host webinars on the Thinkorswim platform 19 years ago. I still remember sitting at my desk on Wall Street, looking at that options chains page and being confused as to what I was looking at, and just watching Tom every single day, showing us how to trade. That's why I'm here today. Honestly, Brian Overby, you were with Tom at that time. So watching the two of you learn how to trade options from the two of you, it's fantastic to bring it full circle and be able to interview both of you on options trading. So first of all, Tom, I just want to give you an opportunity to tell everyone, for those who don't know who you are, a little bit about your background, and then Brian, I'll do the same for you afterwards.
All right.
Sure, happy to. I mean, I love that intro because it makes it does make me feel a little old, which I don't like, but it makes me feel like I've been around a while. But I have been around a while, like over 40 years doing this in this business, 20 years as a market maker, and almost now 20 actually 19 years as a market maker and 25 years building Thinkorswim and then building tastytrade. And so a lot of history on the market making side of the business, a lot of history on the software development side and the content development side for the last 14 years along with software. But it's funny, when you told me that Brian joined your team, I was like, holy cow, like I haven't I think a couple of years ago, Brian and I did a seminar together for somebody at some event, but I haven't seen
Dan
Brian in a
Sheridan.
while.
It was Dan Sheridan way
Oh yeah,
back.
Dan Sheridan, right? A couple of years ago. And there was a time, I was like, um, Brian and I have always stayed in contact throughout the years. I think I tried to get him to come back to Tasty or something at one point, and you were kind of, you'd moved out of state, and listen, life is weird that way. But I remember when Brian was an instructor at the SIBO,
Mhm.
and correct me if I'm wrong, because this we're talking like 24 years ago, Brian, but I think you were an instructor at the SIBO and you're
I was.
working for the exchange, and we convinced you to come on over and run education for us at Thinkorswim, and we had a really nice run until some firm scarfed you and to build their platform out. So but and you told me
Yeah,
at the time.
yeah. The name of the firm, and I mentioned that too, Tom. What we kind of brought it up a little bit, but yeah, it was Options Planet way back in the day. And it didn't last that long under that name, but I remember we were doing an education platform, and we needed to separate church and state. The education wanted to be separate from the actual brokerage firm to try to keep FINRA happy. But yeah, that was 20 some years ago. Honestly, yeah, scary thought.
Yeah, so our paths we've crisscrossed, throughout the years, and different stuff, and different educational events, and things like that. So we've, always maintained friendship. The funny thing about this business is you can never burn any bridges. It's amazing. It's a small incestuous business, and everybody seems to come full circle, like you said, Tony. And when you said Brian was going to be on this webinar today, I'm like, oh, that's cool. We haven't done something together in a while, and I don't know if we still think exactly alike, or but we definitely bring, very our own personal kind of stories, and our own personal methodology, to the game. And so I think that's kind of cool. And listen, as long as we give quick takeaways today and people get a lot out of this, it's going to be a great day. So let's make it happen.
I
Excellent.
agree. Thank you. Brian, a little bit of your background for those who may not know who you are.
Yeah, well, Tom did a pretty good job of summing it up. Worked for a few brokerage firms, but the times that I remember the most, some of my fondest memories, Tom, were like way back in the day. It was myself, and actually, when I first did my first event with OptionsPlay, somebody brought up Don Kaufman's name. So we were the first two instructors with Options Planet way, way back when. And one of the favorite things that I used to do, and I still have fond memories of, is traveling to Vegas and actually doing trading shows. I think it was once a quarter or so, maybe a little bit more frequent than that.
A
And
little bit more frequent, but
what
we
was it?
got to be careful getting into those stories, because that could go on. We could tell about 5 hours of stories here, and we can scare the children. But what I was actually telling a story the other day, that we were doing a show in Vegas back in like 2002, or I think it was 2002. And we started the show on a Friday morning at 4:30 in the morning, and there were people online going into Rain, the nightclub, and the nightclub line snaked around the whole building at 4:30 in the morning, and we're going in to start trading options to make the opening at 6 o'clock into the ballroom. And that's how crazy a scene that was back in the
Yeah.
early 2000s. So yeah, good memory.
Yeah, and it's amazing how many people would show up live. That is the kind of where I was going. Every single one of those events, we would have hundreds, if not thousands, that would come in, even just to see me. I used to do demonstrations of the platform back then, and just amazing how many people would show up live for those events. It was very impressive.
Yeah, so both, what I'd like to just start this off with a bit of a fun question here. You guys have obviously been in this industry for a long time. What has changed? What, from your perspective, has surprised you in terms of change in this industry that you never thought would happen, and what hasn't changed since you've started?
I'll let Tom go because he obviously has the seniority in this situation.
Well, I think, Tony, the I think maybe I'm not as surprised by this, but I think that, to answer your question, the I never thought that we would see a time when derivatives based on capital efficiency would dominate the trading landscape. So right now, at most of the online brokerage firms, not all, but most. When I say most, I mean, everybody from Tasty to Interactive Brokers to Thinkorswim to Robinhood. The marketplace is dominated by the derivative side, even E-Trade, to a certain extent, even Fidelity. And you're seeing, the stock trading account for maybe, in most cases, 20% of all the retail volume, max 25%, and the rest is really derivatives. And it's because people understand how important capital efficiency is today. So I don't think that 20 years ago when we started, the amount of derivatives business that TD Ameritrade did was about 8% of their total business. And so the thing that I think I feel most proud of is kind of changing the landscape of individual self-directed investors, moving from kind of um, very static equity investments, not necessarily passive, but like static and day trading, that kind of stuff, into a world of strategic investing that is highly leveraged, capital efficient, and very strategic.
Thank you. Thank you for that insight. Brian?
Well, yeah, and I still even I mean, one of the things that Tom did and his whole company back in the day is make it all about education and make it about knowing that option traders want to talk amongst each other. Like Tom has mentioned, it's a very tight group, and one of the biggest things that we'd focus on is just like trading groups. There were people in libraries all across the U.S. way back in the day that would always get together and talk about option trading, and that has really been steadfast as far as that whole group of people and how much it's like getting together. It's almost, I'd almost equate it to how fantasy football made the NFL what it's made. I mean, all the option traders always get together, and the fact that it's getting easier and easier to do that is a big reason why there's so much growth in that space.
Yeah. Well, let's jump right into it then. Let's talk a little bit about the current markets. And, I'd like to ask both of your opinion on this because I actually don't remember the last time where we saw S&P 500 at all-time highs like this and the VIX trading above 20%, well off the lows. Tom, what's your take on kind of why we're seeing this dynamic and how do you actually trade this type of market?
Well, there's no question that there is this would be considered, if you told me that we're making all-time highs, I would have given you a VIX market of probably like 13, 15, would have been my two-sided market. So you're right, the VIX up above 20. Part of it's a reflection on just, things that are happening with respect to interest rates right now, things that are happening with respect to the election coming up. I'm sure that all is a part of it. But the strangest thing about this market that I can remember, the strangest thing about this new high is that there is also a crazy amount of protection being bought. And there are a lot of people that feel differently about this being a new high than I've seen in the past. Usually you get an incredible amount of complacency when the market makes new highs, and that's why volatility gets so cheap. This time around, we're not seeing any of the complacency. In fact, what we're seeing is an expansion of fear. And, as you can tell, witnessed by a very high skew, witnessed by just incredibly large amount of put volume, especially in the index products. I think there's a certain preparedness for some kind of, downside risk or downside velocity that we usually don't see at market highs. And so, I mean, to be fair, I think that bodes pretty well for the market as a contrarian. But the other side of it is, I just don't think we've seen this very often. It is not typical that the market is prepared for something ugly to happen at all-time highs. That's just not normal.
Yeah. Brian, thoughts?
Yeah, well, we had hotter than expected CPI, and then you also come in and you see, the debate about jobs versus inflation. Where is that taking us to? Seeing the VIX at this high, which seasonally, going back 20 years or so, September and October have been, just in general higher volatile months. But to me, with the market at an all-time high, well, yeah, once again, you just don't anticipate that. So, you're talking about a trade that we like to do in a market like this. Is I've actually been trading VIX options, and one of the things, and this, I kind of meant to say this when we're talking about things that you didn't expect. I was actually on the retail markets committee for the Chicago Board Option Exchange, and when they talked about trading VIX options, I was dead wrong. I said there's no way that people would understand them and that the product wouldn't take off. That was my opinion back then, but obviously I was dead wrong on that, and that it's had extremely great volumes. And I like to trade the VIX in September and October, and I like to put together strategies. There's so much volatility in the options contracts. It's just kind of fun to come up. To me, it's a fun index to trade, especially when you have situations where you're at an all-time high and you're seeing the VIX up around that 20 level.
So do you see, like Tom, this as a bit of a contrarian event where this potentially could be a positive for equities? Can
I
you
think,
guys hear me?
yeah, we can.
I can hear you. Was that question to Brian
Oh,
or me?
oh yeah, that was a question to Brian. I was asking Brian if he also
Okay.
sees this this
Oh,
market dynamic as a bit of a contrarian that's positive for equities. With the VIX at 20, but we're at all-time highs. Is the market maybe over anticipating or maybe overly fearful about downside risk?
well, we got the big unknown event or a known event that's happening in November, and I do think that the market wants to get past the election before it decides which way it's going to go. And I feel like that has a little, and that's the thing about the VIX, is it's really just a feel scenario that has a little bit of the reason why we're seeing the VIX at these high levels. And I'm not necessarily saying that whoever wins the election, the market's going to go up or down. I just think that known event needs to go away. Interest rates obviously are a huge dynamic that's in this marketplace too. That hasn't always been the case, where the Fed is looking to possibly do 4 cuts over the next year, and after this huge run up that we've had in interest rates. So just those little dynamics, and you throw in the obvious, the geopolitical concerns, I do think the market wants to go higher. They will just want a reason to do it, and they need to get rid of some of these speed bumps in the road. Just like Tom was mentioning, how just put premiums are skyrocketing, which is obviously the driver of the VIX at this point in time. But in general, we're coming into earnings. We're kicking off earnings with J.P. Morgan and Wells Fargo and the financials tomorrow, and I really think that those are going to be very interesting earnings reports, and just actually their opinion after the big event, after their earnings announcements. And I think the market, so in general, to sum it up, I think the market wants to go higher. It needs to get past the election and get a little bit more feel as to what the Fed is planning on doing going into 2025. That's simple.
Thank you. Thank you. I appreciate that. So let's jump into kind of the part that I think we're all here for, which is I'd like to ask both of you, what's the number one option strategy you trade in your portfolio? What strategy do you trade most often? And then we'll kind of get into rules that you have around entry and exit. And then if you want to go through some examples, Tom, with using the Tasty Trade platform, feel free to do so. But let's start off by what's the number one option strategy that you use most often in your portfolio? And if you can tell us a little bit as far as why.
Sure. You want me to start? I will. Um,
Yeah.
so I guess I would define myself, Tony, as a premium seller. I think I always have been. Um, let me put this way: I always have been as a retail investor, as a self-directed do-it-yourselfer. I've always been a premium seller, and so that that puts me into a certain category of strategies. And I would say that I'm lean towards about 75% undefined risk and about 25% defined risk. If I looked at all the different things that I do. Excuse me. Sorry. So
Bless you.
given that I'm 75% undefined risk and 25% defined risk, and most of my defined risk trades, I would argue are probably like iron condors and straight, short verticals. Just one half of an iron condor. That'd be most of my defined risk trades. So most of my undefined risk trades, the majority, and again, I do almost every strategy, so I don't want to like make it seem like I'm a one-trick pony. Because most days I still average about 100 trades a day. So I would say that the majority of my trades are short strangles, because I don't tend to sell one side. I might ratio the strangle, but for the most part, I am a strangle seller just outside of the expected move. And so that tends to be, I'm a high volatility strangle seller just outside of expected move. So Tony, we've talked about this kind of many times. I look at IV rank. I choose my strikes outside of the expected move. I sometimes skew them a little bit just based on my own opinion of, whatever price extreme is. And I tend to go out at least one full cycle. Ideally, I'd like to be out at 45 days, but it could be 35 days, it could be 50 days, but 45 days is a sweet spot of my cycle. So 45 days out, just outside the expected move, which is like around the 20-ish delta on both sides. Skew it a little bit if you're a little bit bullish or a little bit bearish, give it a little bit of skew, and stay relatively small and put on lots of underlyings and only trade things with high implied volatility rank.
Perfect. So let me just summarize this.
Okay.
I think you made it clear you trade a pretty wide variety of strategies, but you certainly lean towards premium selling, and within that premium selling, you're doing predominantly strangles, some iron condor, some credit spreads, and then when it comes to strangles, you're going out roughly 45 days, and we can talk a little bit about as far as why that's the case. As far as strike prices go, you're selling just outside of that expected move, which you can also think, similar to one standard deviation, roughly 20 deltas, and you are doing it across single stock, I'm guessing, both single stock and index, with that have high IV rank. Is that a good summation of kind of what we've
That's
worked
fair.
through?
I'm indifferent to product. There are a couple of things that I don't sell premium in. I don't sell premium in volatility underlyings. That's where Brian and I might differ a little bit. I don't sell volatility underlyings. I don't sell premium in biotechs. And I do use the same exact strategies in futures options as well. So I don't limit myself to just equity options. So my scope is I like highly liquid underlyings because that's really important to me. So I guess there's probably about maybe 10 to 12 different futures options that I trade, and probably, let's call it 70 to 80 different equities that I trade. And I'm including indexes with those equities. So ETFs, indexes, and equities.
And I think one detail that I think is incredibly important to the success of the strategy that you mentioned that may have just been that slipped through is the fact that you said that you keep your size small, but you do it on a lot of underlines at the same time.
I'm a big believer in, so I have a couple things that I live kind of by as a trader. One is I'm an efficient market freak. So I believe that prices are relatively efficient if you stick with liquid underlyings. So I don't worry about, macro stuff and geopolitical events and things like that, because I feel like everything's built in to the market, that sense. But I also have learned over the years that there's a couple of aspects of trading that are really important to achieving your objective. And one of them is creating enough occurrences so that essentially, the law of large numbers kind of plays out in your favor. And I find that when I try to be very selective and trade larger, I do, I don't do nearly as well as when I trade smaller and I'm less selective, because I have to recognize that I really, even though I have maybe a personal opinion on something, it doesn't really mean anything, because I don't, I'm not necessarily right more than I'm wrong when I'm guessing market direction.
And I think that's an incredibly important detail on the success of this strategy is that, as you said, the law of large numbers. And I think this is a concept that a lot of retail traders may not necessarily have a good grasp on. And I think this is something worth exploring for those of you that are maybe hearing this for the first time, of trying to grasp that concept of what it means to trade small, but spread the trades across a large number of underlyings, especially in strategies like this, where you're selling premium and you're collecting premium and you're effectively trying to, effectively trade the mean reversion of volatility here. So thank you so much for sharing that, Tom. Can I just also ask you on kind of trade management? So let's talk
Sure.
about this 45-day 20 delta strangle. How do you manage those trades? Do you hold them to expiration? Do you
No.
manage them? What's your
Yeah,
thought process there?
I'm another one of the byproducts of so Tasty is a think tank. But the content part of our business is a think tank. I know Brian used the word education before, but I like to think of education as being very static. You know, you and I have talked about this before, and I like to think about like the stuff that you do and the stuff that we do. It's much more content because it's always dynamic, it's always flowing. And I think that with respect to the content and the research that we've done over the last decade, uh, one of the things one of our biggest takeaways is that if you manage the trades early, that's about, let's call it halfway through the life cycle. So I manage everything at 21 DTE. So if I put it on at 45, I manage at 21, roll to the next month. By doing that, you're living in the optimal part of the decay curve, and you're also virtually eliminating your outlier risk. You're not eliminating your risk at all. You're eliminating your outlier risk. And because most outlier risk happens in the last, week or 2 weeks when when you get these gamma explosions and things like that. So my focus is manage early, eliminate the outlier risk, and, kind of live in the sweet spot of that decay curve.
And just so let's kind of there's two parts that I want to ask you, right? When you refer to the sweet spot of the decay curve, what I'm presuming you're saying here is that that's really where you're getting a good amount of theta decay, but you don't have much gamma risk yet.
Exactly.
And that once you kind of cross 21 days, that's when, yes, theta is faster, but gamma risk actually starts to kind of work against that.
You're spot on. From 45 to 21 days is the sweet spot. And what's really interesting when you look at the numbers and you look at your P&L per day, and you look at, it's basically, this is a theoretical discussion, but when you look at your theoretical P&L per day, your theoretical P&L per day from 45 days to 21 days is higher than it is from 21 days down to 0. And what's so fascinating about that is your decay accelerates as you get closer to 0, but your theoretical P&L actually goes down. So when you look at it and you think, well, why would I take more risk to make less money? I would rather live in the part of the cycle where I'm taking less risk to make more money. And that's one of the biggest takeaways that we've learned and that we've researched like extensively, like literally hundreds of thousands of hours over the last, 14 years.
And what's interesting is that over the last 14 years, the concentration of strategies is now predominantly in 7 days or less, right? What I think close to 50% of volume now is traded in strategies that are 7 days from expiration or shorter.
It's really wild, and it's a fascinating thing because the 0 days and the 7 days and inside of that are really interesting from many perspectives. They're interesting from a brokerage perspective because, the one thing we like about running a brokerage firm, the one thing we like about the 0 days is that we don't have any overnight risk. So that's a kind of the subtle good part of the 0 days. The bad part about the 7 days and in is that statistically, it's a lot of it's a lot of risk one to make some multiple of one, but it also has a much lower probability of success. So there's a much lower success rate for individual investors when you trade 7 days and in. So the challenge, and again, another really big challenge about trading short-term options is you want to manage those trades early. So if you're doing like a 5-day trade, you do not want to let that trade go more than 2.5 days. If you're doing a 2-day trade, you don't want to let that trade go to the second day. And if you're doing a 1-day trade and you put it on in the morning, you don't want to let that trade go past noon. Like there's this whole kind of universe of information, of data, of all the statistics that we've been able to grind out. And it's super fascinating. We have 18 months now of 0-day data, and managing early in the first half of the day is just the results are incredibly different than holding to the close.
That brings me to the last part of my question about your 45-day strangle strategy. You said you manage at 21 days expiration. Do you ever close prior to that based on
Of course.
a stop loss level or a take profit level?
Of course. In fact, the default for every single person listening today should be, the default is always to close earlier. Like if you're thinking, if it's a no-brainer, you're like, I like this position, I want to hold it, fine, go ahead. But if the decision is, should I take this profit or should I not? Our default is to always take the profit, adjust the trade, roll it, hedge it. We're super aggressive in that regard because the markets today, if you're trading liquid underlyings, the markets are so efficient that you're only giving up a penny or two. And just to learn how to take profits, to learn how to make those trades, the more times you do something, the better you get at decision making. You and I have talked about this so much in the past. The quicker you process stuff, the quicker you redeploy. I just feel like the default is always better to do something sooner than wait.
Perfect. Thank you so much. So Brian, let's switch gears over to you. What is your number one strategy that you use in your portfolio? And if you could share with us a little bit as far as why.
Well, I'm going to let Tom have the short spreads and basically selling premium overall. And I was going to kind of address this a little bit by just talking about a trade that I did in the VIX recently, using a butterfly on things that have high volatility, where you want to play a direction. And I usually like to try to modify that trade. Now, I can do one of two things. Tom's talking a little bit about short spreads. And I know that I don't want to put words in his mouth at all, but I know that if he were looking at butterflies, a lot of times you're trying to do them for a net credit, trying to bring in a skip strike butterfly or a modified butterfly in that instance. And I've listened to Tom for years and years and years, but so I like to call it a skip strike butterfly if I'm looking at a butterfly, and I'll just kind of leave it in this range. And I want to talk about the couple of trades that I've done recently in the VIX is, if I look at a skip strike butterfly, I'm really embedding a call spread to pay for a standard butterfly. And I like to look at it that way. And that's why in the playbook, I wrote, when I put the strategy together, I called it a skip strike butterfly instead of a modified butterfly, because you're already embedding your hedge into the trade. If I'm short a spread and the market starts coming towards my short strike on the put side or on the call side of things, if you can get it done for a decent net credit to the account, you're already got some protection into the trade. And I'm willing to stay into that trade a little bit longer, hoping that maybe I'm doing it based off of a support or a resistance level. So that's kind of my way to approach doing short spreads from time to time. Everything always depends on the underlying stock. But like recently I looked at the VIX going into September and October, and maybe Tom can opine on this a little bit, but I've never known the rationale behind why September and October over the last 20 years, looking at the calendar, usually the VIX trades at higher levels just in general. It's a fact by looking at the data from going all the way back to the last 20 years was the last time I put all the research together. So with that said, going into September, literally the last day in August, I put on a modified butterfly where I like to the long side of the butterfly, because it's made up of a long spread and a short spread. the long spread is wider than the short spread. And you can call it a weird butterfly. To me, that's a true modified butterfly, meaning that if the market took off, you're in the VIX index and it skyrocketed like it did in early August, you're still okay on that trade. You're still profitable on that trade. So Tom obviously went to the nth degree talking about selling premium and all that. This is one trade that I kind of like. Like even back in the day, butterflies were a way that you price options, make sure that all your chains were correct, because they're such an efficient strategy by looking at them and going from a long spread, turning it into a butterfly, going from a short spread or going from a butterfly and turning it into a short spread. These are some adjustments that I like to make in my trading, and that's one strategy. That was a strategy that I did recently when you asked me this question and thought about that. Turned out that worked really well. Market was at 16, put on the 18, sold the middle strike around 26, and then modified it in case the market took off. And literally the first day in September, the VIX skyrocketed, and it seemed to do that again in October. So I would like to know, why is that? What are your thoughts, Tom, on why do we get into September and October and the VIX seems to just take off?
Well,
I really don't have a feel for it.
A lot of memories, maybe.
That's true. A lot of Mondays in October, probably, right?
Yeah, October 19th is 1987 is stuck with me forever. It was kind of the first. It was the first kind of earth-shaking moment for me in this business. The mini crash in 1989, the October 2008, was an absolutely brutal meltdown. And I think that when you just, I think a lot of traders have some of those dates just kind of ingrained in their head. But the reality of October expiration, or October first as one of the most volatile months, it's actually not even the most volatile month. It's crazy, but like April and July, I think are actually more volatile than October. September might even be more volatile in history than October, which is kind of nuts. And when you look at October expirations going back like the last 26 years, I think, because we always think of October expiration, kind of that 19th, 20th of October is crazy. But the reality is 14 of the last 26 have been up, 12 have been down. So it's kind of like a really mixed bag, but we all have these memories of like, October 19th, October 17th, October 22nd. And so I think, I just think it's more like, the shock value of some of those crazy, VIX moves. And I mean, the three of the, in the last 35 years or whatever it is, three of the greatest VIX moves getting over 80 or getting over close to 100 have always come in October. And I think that's it, Brian.
Yeah. Yeah. And I would agree that's just basically my feeling. And the way that I look at it, we got earnings that always comes in, usually this time of year, and, we're about ready to kick off that earnings season. But, the big unknown event, once again, is the election. So, So that's one way that I do agree with Tom. Selling premium, going out 45 days allows you to adjust the trade. If I'm doing butterflies, I'm going to do them shorter term, because you do want the time decay to work with you, but you're kind of putting your hedge in. And that's what I meant by, if I'm looking at a shorter term short call spread or short put spread, maybe think about a skip strike butterfly, because it does give you the protection before you go into the trade. But it's really all about the volatility of that underlying that you're trading. And if you can go a decent amount away from where the underlying stock is at and get a credit by making it a skip strike butterfly. And I'll leave it there, Tony.
So let me ask you a clarification on this, right? If, let's say, you have a bullish view on a stock and you're trading a butterfly versus a bear stock on a different stock that you're trading a butterfly, are you using call butterflies, put butterflies, iron butterflies? What type of butterflies are you using specifically?
Well, yes, you're going to target it. You want to trade the lower price option contract. So if you are bullish on the underlying that you're trading, you're going to use calls. You're going to go out of the money. You're going to target a certain point where you might use some charting, you might use some technical analysis to come up with that. And then obviously on the other side of the coin, you're going to do that also with put butterflies. And one of the bigger things too is that I have a tendency to, if I want to be bullish on something, implied volatility, you want to come in if you're correct on your forecast. So if you're buying a butterfly out of the money and you're correct on your forecast, you are hoping implied volatility will go down on that call side of things, and that will help out the butterfly when it's all said and done. But butterflies aren't all about home runs, right? You're putting them on, hoping that you pay a dollar for a butterfly and you can sell it for $2. Like that's the way that you're going to trade those positions, and even usually we'll make one adjustment if I'm doing some type of butterfly too in that trade.
Right. So you mentioned that you use shorter dated expirations. Roughly how far out do you like to go for your butterflies?
Well, it would depend on the underlying, but let's use the SPX for an example. I want to probably stay with a lot of times when I was really first started trading. Even long spreads and would roll that into a butterfly as a chip in a chair trade. I don't want the cheese anymore. Just let me out of the trap scenario. Look at 5 days. Put it on a Monday, get out on a Friday. That simple. In the VIX trade that we just talked about, the VIX, the only option contracts that I really like to trade that are liquid enough are the ones that actually expire the normal monthly expiration, the third Wednesday of the month. So that was an 18-day trade in the VIX. And like that would be the maximum that I would want to go out on a trade where you got a lot of volatility in that underlying.
Great. And lastly, how do you think about generally managing these?
Well, it's hard to go about without an example, but like in the VIX, if I did a bearish put butterfly and let's say the market moved about 2% against me over that week, I like to then close the most expensive option contract and actually roll it into a short put spread and get bearish on the market. And that's once again just following the trend, and it's one adjustment. The market turns on me, I get out right away. But it gives me an opportunity to put the trade on. Okay, I was wrong. The market is going the other direction. Let's sell the most expensive option contract and buy the least expensive option contract, bringing in a net credit to the account, still giving me a chance to be profitable. And now I am in a short spread position, a bullish position. And we recently did a little bit of that in the education here on OptionsPlay not that long ago. So there is a webinar out there that we chat about it a little bit in.
Perfect. And we'll link to that in the recording. So Tom, I want to give you an opportunity to kind of bring up the Tasty Trade platform and maybe let's go through an example of a strangle that you might sell on perhaps a single stock that you've identified, something with a relatively high implied volatility, how you set up that strangle in the Tasty Trade platform. And just let's go through a real example if you don't mind.
Okay, so I'm going to go to share.
Yeah. Let me make sure that you can share. 1 second. You should be able to share.
I should be able to right here. Let's see. And I want to go to application window and share. How's that?
Yep, we can see it.
Okay, let me just get rid of this so I can get rid of this. Okay, perfect. Let me get rid of these pictures. Beautiful. Okay, sorry about that. I just wanted to get it all set up so you can see. So this is kind of the basic, this is the basic Tasty platform. We have a very straightforward, simple interface. The Tasty platform, for people who have never used it, it's the only retail platform that's built on pure high-frequency middleware, so it's super fast, super easy to use. Stock options, futures options, everything trades from the same interface, crypto, everything. But what I did here for you is just bring up, to give an example of what I talked about with Tony, I just brought up Tesla. And the reason I brought up Tesla is if we want to talk about the most liquid underlyings, Tesla and Nvidia are probably the two most liquid equity underlyings. I think that's fair, right, Tony? Tesla and Nvidia, in my opinion, are the two most liquid underlyings.
Yeah.
Also, Tesla has a binary event tonight, which is why I brought it up. So you can, so it was really active today. Nvidia was active as well, but I thought I'd start with Tesla because they have like kind of their robo taxi binary event, something later on tonight. So there was a lot of premium jacked into Tesla. And one of the things I mentioned when I talked to Tony about, what do I look for? The first thing I said was I look for liquidity. And obviously Tesla has huge liquidity. This is just after hours volume here of, over 2 million shares, but I don't even know how many. I've probably traded 100 million plus shares today. In addition to that, you can see the IV rank here is 82.3. So what that means is on a scale of 1 to 100 ranking, it's at the 82, 83rd kind of level or number, which means that's close to as high as it gets. Now, occasionally, like just to give you an example of just showing you some stuff with crazy high implied volatility, because we're in one of those times, like crude oil has a 99% implied volatility rank right now. That's about as high as you get. But those are futures options. So let's go back to listed equity options because these you can get a little smaller on. And this is Tesla. So the way the Tasty platform is set up over here, this is kind of these are all just futures markets. These are obviously by choice. This drop-down menu is called Tom's Default, so anybody can get it. And I just list the equity futures, and this Tesla would be in the NASDAQ futures, and there's just a bunch of other futures here. And then if you scroll down, there's lots of stocks and things like that. We built the whole platform around watch list mentality. But like I mentioned to Tony, I want high implied volatility rank. 82 is obviously just about as high as you get. I want huge volume, and this stock has massive volume. I want stocks that have high implied volatility, and this stock has an IV. Now, this is not IV rank, but an IV of about 70, which is very high. Because when you think about a 70 implied volatility, what you're really looking at, a 19% implied volatility is about a 1% move a day. So when you have a 70% implied volatility, you're talking about an average daily move of about 3.5%. And on a $250 stock, you're up there in that $7.5 to $10 range just based on implied volatility on a daily basis. The other thing that's cool about the Tasty platform is we show you what the expected move is. Now, I don't have all the strikes listed here, but if I push them all up here, you can see that the Tesla one day, just because the binary event tomorrow, the expected move overnight is $14.30, which is much higher than the regular average daily move. Because you can see here, the implied volatility for one day is 130 or something. So that's because there's a binary event coming. But when I make trades, I like to go out about 45 days. So in this case, I went to closest to 45 days, which is November options, which are, in this case, 36 days out. And the first thing I look at is the expected move 36 days out, which is $36 or $37. Now, when you have a binary event coming, you're looking for something kind of, with heightened volatility, and you want to take advantage of potentially that extremely high binary event premium or that event-based premium. What I did, and I did this very late in the day because I was just kind of fooling around in Tesla. I went out to November options. I opened them up and I said, well, if the expected move is $36 or $37 to November, I'm going to go twice the expected move just to give myself a little cushion, a lot of cushion. So I went out, and you can see right here, because these are just some small Tesla positions we have on. I sold a 20 lot of the 170 puts, and the stock closed at just about 240. They're $70 out of the money. So they're just about 2 times the expected move to the downside. And then to the upside, I sold the 350 calls, which are $120 out of the money. Now, the reason you can do that for basically the same amount of money is because these were $1.35. These were $1.35. They were the exact same price. And the reason you could do that is because in Tesla, the market perceives the risk to be to the upside, the velocity of risk to be upside. The market does not saying the stock's going to go higher. It's not saying that at all. What the market's saying is if the stock does go higher, it will go higher faster than if it goes lower. I know that seems a little weird, but it's called pricing skew, option pricing skew. And all the market's saying is the velocity of risk is to the upside. It's not saying that there's a better chance the stock goes up than goes down. It just says if it goes up, it's going to go up faster than if it goes down. And because of that, I was able to sell this spread. And actually, I was able to sell because I sold a few minutes before the close at $2.71. Now, is that a good trade? I don't know. We'll see tomorrow. Maybe it comes in, and I also have another strangle on here too. So in total, I have two different strangles on in Tesla, and they're both basically the same kind of positions. They're delta neutral, meaning there's zero deltas to this trade. Now, that's almost exactly what I explained to Tony before when we talked about favorite strategies, except in this case, I'm doing it around a binary event. So this is one strangle we have on. The other one, we're short the 320 calls and we're short the 190 puts. So I have a couple different strikes here. It's like two different strangles, but that's kind of what I'm betting on tomorrow, that this $8.55 premium is going to come in. And I'm hoping that the Tesla news is kind of a non-event. And I'm hoping that it stays inside the expected move of $14. And if Tesla is inside of $14 on the opening tomorrow, this strangle will probably trade down around, somewhere around $6.50 to $6 to $6.50 is my guess. And that is a play. Now, when you look here, you can see the Greeks. I mean, this is the probability of profit on this trade that I have on 82%, which obviously I like. The probability of making 50%, well, it's a little bit misleading, but it's 88%. Misleading only because I'm not going to hold it that long. The deltas are basically flat, and the beta-weighted deltas are basically flat. And, when you look at different things, one of the nice things on the Tasty platform is we also show you CVAR, what happens in the worst 5% of all cases. So if you were to do this as kind of a one lot, this would be your CVAR, which means, because a lot of people are like, well, what's the worst damn case? Well, this is the only platform that kind of shows that to you, because it's hard to give you a worst case scenario on an undefined risk trade. But I like trades with defined profitability and undefined risk, because we give you CVAR. So in this case, max profit is 855. This isn't max risk, but this is the most likely risk of about $7,000 with an 82% probability of profit. That's the kind of trade that I like. And hopefully, Tony, that kind of makes sense. It's a non-directional trade. It's just playing, hey, you know what? I like these odds. I like the high probability of profit. I like the high implied volatility. I like it wrapped around a binary event. And I like this ratio of, of what I think kind of worst case is in 2.5% to 5% of the time versus what I'm going to make on kind of just a normal move.
Thank you so much for that breakdown. I think we covered a lot of the things that we talked about before. I do want to cover this concept of CVAR and thinking about this and going back to that concept that we're talking about in terms of law of large numbers, right? Because you're obviously working with a sizable account here, and you can trade positions of this size. But let's think through someone who has, let's say, a $50,000 portfolio, right?
Sure. So let's do this. Let's do this. Let's get rid of this naked option. Let's get rid of this. Delete this leg. Let's get rid of this leg. We'll delete this leg, and let's talk about this. Let's tighten up this triangle just so people can see better. So I can see from one screen, so you don't have to look at multiple scrolling and stuff like that. So let's say that this is the strangle that somebody had on. I'm just doing it so you can see. And you have limited capital. So that's one choice, obviously, is to put a position on like this, or you can iron condor it off by just, buying a wing. And you could put this wing anywhere you want. If you want to move it, a bunch of different strikes, you could just drag it to wherever you want. I mean, just to define your risk basically changes the dynamics of how much capital you have to use. Same trade. It's just a little bit different synthetically, because you're going to give up some of this premium as it evaporates as well, but you still have generally the same concept on.
So you would use the same 45 days, you would use the same strikes in terms of selecting which ones you sell, and you would use the same method for managing this trade.
I would do everything the exact same, because I would consider this, in this case, essentially to be, when you do any kind, and I'm just doing this so you can see it better. If we do any kind of an iron condor, I'm doing it so that I'm just creating defining the risk to create capital efficiency. You do hurt your, you do, depending on where you move it to, you will knock your pop down. I would knock my pop down in this case from like 82 to like maybe 67%. So it changes the probabilistic outcome. But it also reduces the delta risk. And you can see here your C-bar goes from, let's say, 7,000 down to 500. And your max profit only drops in half. So your return on capital goes significantly higher, but your probability of success goes down. The one thing about options that everybody listening should really just always grasp is they are symmetrically perfect as far as risk and return goes. We have this thing called put-call parity. And because of that, and because of efficient pricing, everything works out the same. There's no difference between the risk you take in doing trade A versus the risk you take in doing trade B. It's the mechanics that you use and how you optimize those mechanics, which will determine different levels of success. But as long as you're trading a stock like Tesla, as an example, you're never going to get inefficient, bad theoreticals or inefficient pricing. Every dollar at risk is going to be virtually the same, but then it's how you tweak, manage, adjust, close, do everything else that really gives you that optimization and the efficiency of optimization.
I think that's a really important concept for a lot of traders, especially retail traders, to wrap their heads around. Because what you're effectively saying is that that trade before that you showed us with that had 80-something probability of profit is no better as a trade than this trade that only has a 49% probability of profit.
That's
Yet
exactly
I think for
right.
a lot of traders, mentally speaking, doesn't something with 82% probability of profit sound so much better than something with a 49% probability of profit? And I think that's a really, really sometimes difficult concept to wrap your head around, but that is true. And it's really hard to sort of sometimes explain that. But really, the trade with an 82% probability of profit has a far worse risk to reward ratio than the trade with a 49% probability of profit, which has a far better risk to reward ratio. And that's that counterbalance between risk to reward and probability of profit, as what you're saying is that there's no optimal, there's no best balance, if you will, between those two, because the markets are efficient. It doesn't matter where you are; they're kind of all the same, if you will. It's how you manage the trade that defines your outcome.
That's right, and that's why we included CVAR on the platform, because conditional value at risk is, or some people use value at risk. We use conditional value at risk because we set it kind of to a 5% level. But it's really fascinating when you look at kind of real risk, and you start to recognize that that's also how the regulators view risk at essentially that 5% level. So it's a very fair number, and it kind of ties this all in together. You're right. There's no difference as far as there's no theoretical difference with respect to edge of doing this tight iron condor versus doing that really wide strangle. The difference is in your probabilistic outcome and your risk reward ratio. That's it.
Well, a lot of insights here today, a lot that we've covered. First of all, I want to thank both of you for your time. This has been incredibly insightful and incredibly fun, honestly, just to chat with both of you and kind of get your insights with regards to the markets, with regards to your favorite strategies. I had taken the time to take notes here so that we will share these notes with everyone after we put up the recording. But before we wrap up, I do want to just leave for everyone who does not have a Tasty Trade account. If you want access to the Tasty Trade platform that Tom is showing you here today, you can sign up for a Tasty Trade account by going to trade.optionsplay.com/tastytrade or pointing your phone to that QR code on your screen. There is a bonus at the moment. If you open up your account based on the levels that you see here on your screen, you'll be able to see the details of that if you click on that link or go to that QR code. So looking forward for those of you that are interested in setting up a Tasty Trade account to go ahead and do so. And once again, gentlemen, thank you so much both for your time. It's incredibly, like I said, fun and insightful to pick both of your brains and better understand these strategies.
Thanks, Tony and Brian. Great to connect again. Can't wait to do more of these.
Yes, definitely 100%. Really enjoyed the time.
Thanks, everybody.
I think, Tom, next time we're going to bring back the think tank and we're going to go over 0 days to expiration. We're going to go over all of that data that you have.
I love it, man. And you know what, Tony? Also, we've been doing a lot of stuff with VIX 1 day and tying it into the 0 day trading, and so I've got a lot of stuff to cover with you on that. That'd be really interesting, I think.
Excellent,
fantastic.
Thanks, guys.
I will leave this link up on the screen. I will let everyone take their time out of the room, but please, thank you so much, gentlemen. Have a great trading day, and we'll see you guys next week.